My name is Jamie Metzel. I'm Executive Vice President of Asia Society. On behalf of all of my colleagues, it's my tremendous pleasure to welcome all of you here today for a conversation on what, at least for us at the Asia Society, is among the most critical questions that we are thinking about, and we know that the world is thinking about. That is essentially, what is the impact of the global financial crisis going to be on Asia? But it's connected to a much broader question. I think that everybody recognizes that with all of the change afoot, with the rise of Asia, the global financial crisis, that many of the structures and institutions and mindsets that we've had for the last 60 plus years since the end of the Second World War are suddenly in flux. We have world leaders coming from around the world next week to the United States to talk about whether it's the reform of the Bretton Woods institutions, or some people are talking about a new set of institutions, Bretton Woods 2. It's clear that the rise of Asia and the global financial crisis are converging and creating a really important moment in not only the history of the region, but in the history of the world. And we are delighted that we at the Asia Society, both here in New York and in our 11 offices around the world, can play some role in facilitating the kinds of conversations and dialogues that will need to happen as we all around the world try to figure out what this means and what the next steps are and how we can build structures not just in the economic and financial realm, but economic, political, even cultural, that can foster a generation of sustainable growth, the coming generation of sustainable growth, in the spirit of the growth and stability that we've had over the past 60 years. So with that, we are tremendously honored to have Kuroda-san with us, who's the president of the Asian Development Bank. And I'm not going to introduce him now. I'm going to introduce the person who's going to introduce him. That's the way it works here. But we have a few people we would like to thank. We have our outreach partners, the Emerging Market Trade Association, the Hong Kong Association, the Fund for Reconstruction and Development, the NYU Stern School, the Weatherhead East Asian Institute, and the U.S. Asia Institute. So thank you all to the outreach partners, to the people here who are associated with those organizations but haven't been to Asia Society events or functions before. We welcome you to Asia Society. We're a membership organization, so if you want to join us, we would love to have you. Just a few very small things. One, it's almost like a cliche, but please turn off your cell phones, or at least turn them to gentle vibrate, non-vigorous vibrate. And with that, just want to introduce Marlon Young, who's going to introduce our speaker, who is the CEO of Private Banking for the Americas at HSBC, and he's responsible for HSBC throughout all of the Americas, which I guess is implicit in his title. So with that, welcome to all of you, and Marlon, the floor is yours. Okay. Thank you.
Thank you. Thank you, Jamie. Good afternoon. Ooh, the cell phone is on. That's a $5 donation to a charitable cause. Anyway, today I have the great honor of introducing you to Mr. Haruhiko Kuroda, not only in the same week during which we have seen great change in the U.S. political landscape, but also at a somewhat turbulent time in our financial markets. As I ponder the remarks that I would deliver before you today, it occurred to me that had we gathered here about a decade or so ago, the topic of conversation could well have been on the Asian financial crisis and how to move forward in recovering from that momentous occasion. Our speaker today, Mr. Kuroda, played a central role in getting the Asia-Pacific region back on track at that time. During his term as Vice Minister of Finance and Director General of the International Bureau, Mr. Kuroda helped design and implement the Miyazawa Initiative, Japan's response to Asian economies hit by the 1997-1998 financial crisis. Under his leadership, Japan helped Asian nations establish the Chiang Mai Initiative, a network of currency swap agreements designed to avert another crisis. Asia's growth story since that time is of course well known and proved the effectiveness of bold measures taken at that time by Mr. Kuroda and his counterparts in the other Asian nations. Moving forward to 2008, we are witnessing a financial crisis that has engulfed many of the world's advanced economies, including us here in the United States and many of the other G7 nations. We have witnessed the remarkable spectacle of prosperous nations such as Iceland and Hungary, the latter a full member of the European Union, seeking IMF assistance to avert insolvency. Over the past few decades, Asia has emerged, arguably, as the third pillar of the international economy after Europe and North America. As such, its current fortunes will be vital in determining whether this becomes a global crisis or can be geographically contained. It is, however, inevitable that Asia's resilience will be severely tested at this time. Mr. Kuroda is uniquely positioned to speak on this issue. As the president of the Asian Development Bank, he heads an institution that serves as the family doctor to about 40 member countries in the Asia-Pacific region. Since the creation of the Asian Development Bank in 1966, it has played a central role in the development of so many Asian nations, and in doing so has forged close ties with the region's top policymakers in both national governments and in regional bodies such as ASEAN. With its exclusive concentration on Asian issues, Mr. Kuroda is uniquely positioned to bring us ADB's crucial insights into the prospects of Asia's weathering of the current storm. Please allow me to welcome Mr. Kuroda-san up in the podium.
Thank you very much indeed for your kind introduction. Ladies and gentlemen, it is an honor to be here to discuss the impact of the global financial turmoil on Asia and the long-term challenges facing the region. The last time I spoke at an Asia Society Forum in New York in September 2005, I discussed the prospects and challenges of Asia's regional economic integration. Back then, I mentioned that it was the Asian financial crisis of 1997-98 that had brought the region closer together, helping forge new regional financial cooperation initiatives such as the Economic Review and Policy Dialogue, the Chiang Mai Agreement, and the Asian Bond Markets Initiative. Now, in 2008, Asia is again threatened by financial turmoil. The trouble that began in the United States last year and then spread to other regions has arrived at Asia's shore. Fortunately, the region learned its lessons well from the crisis of a decade ago. Developing Asia's governments have pursued sound macroeconomic policies, companies have strengthened balance sheets, and banks have reduced non-performing loans. Most of the region's economies are now fundamentally stable, and massive foreign exchange reserves will help ward off the worst of the crisis fallout. To date, individual nations in Asia have responded to the new crisis with level-headed pragmatic measures to limit its impact on their economies. But if heightened financial stress persists, the impact on growth is likely to be pronounced. Investors are already feeling the pain. So far this year, more than $100 billion in foreign capital has flowed out of the region's top stock markets, and market capitalization has plummeted about 40 to 60%. Pakistan, one of our developing member countries, is discussing a rescue plan with the IMF. Many other nations in the region, despite reforms and better economic management, look increasingly vulnerable to a liquidity squeeze, particularly dollar funding. In addition, recent economic data suggests the region's largest economies are cooling quicker than expected. A slowdown in regional growth now appears inevitable. This is, of course, cause for great concern. Any tempering of growth will delay the region's quest to improve living standards for our population, particularly the poor. Since 1990, an estimated 300 million people have been lifted out of poverty. But there remain some 600 million Asians living in extreme poverty on less than $1 a day. We should not forget that one result of the 97-98 financial crisis in Asia was that millions of people were thrown back into poverty. We must do what we can to ensure that does not happen again. Now is the time for both national and coordinated regional action to restore liquidity. Developing Asia needs to take appropriate fiscal and monetary responses to address the downturn. They must explore ways to mobilize adequate financing to fund priority development needs. They must ensure liquidity for their banking systems. In some cases, vulnerable nations may require short-term liquidity support. A portion of foreign exchange reserves might need to be pooled. Existing regional mechanisms must be strengthened. These are just a few actions that region's leaders now need to consider, and I'm confident that they will come through with appropriate and effective responses. Let us now consider in more detail the immediate impact of the current turmoil on Asia and the challenges that lie ahead. When the trouble in the U.S. housing market first came to light in 2008, few could have predicted that it would spark a financial crisis of global proportions. Already, we have seen an unprecedented number of central bank and government interventions to stabilize markets and rebuild public confidence. But while the emergency measures taken so far might reduce the severity and duration of the crisis, the damage to global credit conditions is still considerable. Volatile equity and currency markets from New York to London are just one indication of continuing uncertainty. New trade-related data, reports on unemployment, and pared-back industrial and manufacturing orders are all signs that the global slowdown could turn into a global recession. As global investors scale back their emerging market assets amid continued financial system deleveraging, Asian equities and external funding conditions have suffered. In recent weeks, Asia's stock market indices fell more sharply than those in G3 economies, namely US, Europe, and Japan. Sovereign credit spreads have widened significantly. Offshore bond insurance has dropped sharply. Capital outflows increased due to the repricing of risk and the unwinding of the so-called carry trade. Emerging market currencies also tumbled. All of this will come at a price, and not just to the institutional and retail investors from Seoul to Mumbai, who have seen the value of their portfolios cut dramatically. With plunging equity prices and a timid credit market, many Asian companies will struggle to access capital for expansion and new investments and to refinance existing debt. Despite the large build-up of foreign exchange reserves over the past decade, severe dollar shortages are also testing Asian banks. Access to international interbank markets is limited, and as Asian banks use swap markets in lieu of illiquid international interbank markets, the cost of borrowing dollars increases sharply. This dollar scarcity also has important implications for Asian exports, as liquid dollar supply is essential for trade finance. Trade links between developing Asia and major industrial economies remain substantial despite a gradual decline in overall trade share. G3 economies still account for more than 60% of final demand for Asian exports. With the world's major industrial economies cooling rapidly, regional exports are slowing. Growth in industrial production is also down, and the growth in retail sales is losing momentum. There are clearly some very difficult challenges ahead for Asia. In the short term, Asia's economic and financial systems will likely come under increased pressure as the effects of the global credit shortage intensify. It is extremely difficult to forecast economic growth at times like this. With tightening credit conditions and a deteriorating world growth outlook, not only external demand, but domestic demand will also slow. In 2008, the 9% average growth in developing Asia was the highest in recent years. We expect aggregate GDP growth this year to be lower by around 1.5% than last year's record. The giant economies of China and India, which account for a large portion of the growth estimate, have already seen growth slow significantly. Given the rapidly deteriorating global economic situation, a further slowdown next year is likely to occur. I personally suspect that next year 0.5 to 1% further slowdown compared with this year is quite possible. However, as I implied, Asia today is more resilient to external shocks than it was a decade ago. Several important factors can help explain this. First, better external positions and large international reserves give many countries in the region greater latitude to deal with a financial crisis. Second, the region's financial institutions have had relatively small direct exposure to U.S. subprime mortgages and structured credit products. And third, improved and prudent policies in most Asian economies since 1997-98 crisis help mitigate the impact of external shocks. In many of the region's economies, external debt is far more manageable relative to exports than 10 years ago. Also, in general, exchange rates today are more flexible. Combined with a large build-up in foreign exchange reserves, capital outflows can now be handled more effectively than in the past, and reforms have improved financial systems. Bank balance sheets are typically stronger, the results of post-crisis restructuring and structural reforms, improvement in the quality of supervisory oversight and risk management practices, and reduced fragmentation and government ownership in the banking sector. A range of indicators also point to a healthier corporate sector in Asia. The result is that a full-fledged financial crisis in the region is unlikely. Yet, continued financial instability or any further deterioration in global credit conditions could weigh the system down and hurt broader economic activity. Tighter credit means less private investment in Asia, and because developing Asia continues to require substantial investment to finance priority development needs, including infrastructure, health and education, and technological innovation. This poses a considerable threat to the region's long-term growth potential and ability to continue to rapidly reduce poverty. As the spread of the financial crisis affects regional and global growth prospects, effective responses must be found at all three levels: national, regional, and international. National policies will need to focus on mitigating the impact of tighter global financial conditions and weaker growth, while providing targeted safety nets for those most affected. Specific measures taken will vary greatly depending on country-specific circumstances and resource availability. Luckily, inflationary pressures are receding in the region due to declining oil and other commodity prices, along with weakened demand. From a policy perspective, this inflationary effect, together with the liquidity squeeze that translates into a de facto tightening in financial conditions in some economies, could provide more room for maneuverability. For example, many of the region's economies, including China and India, have already slashed policy rates and eased their monetary policy stance. And the Korean government pledged up to $100 billion for guaranteeing banks' external debt. Several countries in the region have also introduced tax cuts and other fiscal stimulus measures in recent weeks. However, where inflation remains in double digits, such as in Bangladesh, Indonesia, Pakistan, Philippines, and Vietnam, the scope for monetary easing is likely to be limited. In particular, elevated food prices will likely add a significant burden on the poor, as a slowing economy further depresses income growth, highlighting the urgent need for targeted assistance for the poor. At the regional level, authorities need to strengthen their crisis management frameworks. Policymakers should review contingency plans. They should address the ramifications of a weakened interbank market, ensure the adequacy of deposit insurance and public recapitalization schemes where appropriate, and extend government guarantees to bank funding sources depending on resource availability. Liquidity risk management also needs to be fine-tuned. Economies with banking systems that rely on short-term debt, especially in foreign currencies, are likely to face repayment pressures. Collecting and disclosing information on the aggregate profile of maturing debt, particularly external debt, could help individual firms better manage their obligations and alert banks when potential demands for short-term financing arise. Central banks should also consider reviewing the range of available liquidity instruments, including foreign currency. In addition, risk management and bank supervision needs to be strengthened. With growth slowing, corporate default rates and non-performing loans are expected to rise. Banks with large exposure to sectors vulnerable to a domestic slowdown, such as housing, may be at greater risk. Government must push banks to introduce robust credit risk systems to prevent possible spillovers from global risks. They must also work to consolidate supervision, improve communication between central banks and supervisors, address credit concentration, and ensure prompt corrective action for banks and non-banks. While these issues all require a response at a regional level, the question for Asia is, what mechanism, which regional groupings is the most appropriate to drive this agenda forward? While some countries have called for the establishment of a new regional financing facility or a crisis management fund, a general agreement seems to be emerging on strengthening existing mechanisms under ASEAN Plus 3 in close coordination with regional and global financial institutions. ASEAN Plus 3, as you know, includes the 10 countries of the Association of Southeast Asian Nations, plus China, Japan, and Korea. This would be the most pragmatic option. Ever since the financial crisis of 1997, ASEAN Plus 3 has been discussing a means to help each other in emergencies. In 2009, this resulted in a network of bilateral swap arrangements known as the Chiang Mai Initiative. Last year, at ADB's annual meeting in Madrid, and again in Beijing 2 weeks ago, ASEAN Plus 3 nations agreed to upgrade the bilateral system into a more powerful $80 billion fund. This needs to be done swiftly. Expanding and multilateralizing the Chiang Mai Initiative would not imply mobilizing resources to buy toxic assets from regional financial institutions, but rather offering emergency liquidity injections to countries experiencing urgent liquidity shortages. ADB's recently published flagship study on emerging Asian regionalism has proposed the creation of an Asian Financial Stability Dialogue, which would include finance ministries, central banks, and other financial regulators and supervisors. The dialogue process could provide for coordinated effort to address the financial crisis. Many national governments have introduced measures to support their banking systems to help stabilize financial markets and facilitate recovery. Through an Asian Financial Stability Dialogue, countries could coordinate regulatory development and monitor potential financial vulnerabilities using objective early warning systems or other mechanisms. And they could engage the private sector in financial market development. Coordination of these national efforts from a regional or even global perspective could help ensure the actions of one country do not add stress to a neighbor's financial system, forcing them into an ad hoc response. Multilateral development banks also have an important role to play. With shrinking access to private capital, we must step up to ensure that developing Asia has sufficient access to financing through a mix of loans, grants, and credit guarantees to fund the region's priority development expenditures so that Asia can continue its fight against poverty. We must continue with our development agendas, especially in the critical areas of infrastructure, education, and health. ADB stands ready to play a larger role in channeling more resources to developing Asia. But to be fully responsive in the midst of the current crisis, we will need to accelerate the effort, which we began in earnest at our annual meeting last May, to increase ADB's capital. A tiny investment by our shareholders will translate into many billions of dollars of additional assistance that will be critical to ensuring developing Asia has the resources it needs and continues to contribute to global growth during these troubled times. Ultimately, a global crisis requires a global solution. Aside from the immediate short-term actions to stabilize finance, we need a long-term plan for reforming the regulatory and the institutional framework for the world's financial system. There have been lively discussions in recent global forums, including the G7 Finance Ministers and Central Bank Governors meeting and the International Monetary and Finance Committee. We believe there will be a strong Asian voice at the forthcoming G20 Finance Ministers meeting, as well as G20 summit on financial markets and the world economy. With its growing influence on the global economy, Asia must have a seat at any table seeking a solution. This is particularly true given the amount of savings Asia has parked in the assets of advanced economies, including the United States. Asia is poised to take even greater responsibility as a cooperative and responsible partner to help address global challenges. Looking at the long term, we must not forget that there are two faces of Asia. For every glittering skyline of our capital cities and financial hubs, there is usually an adjacent slum. It is our overall challenge to complete the unfinished poverty agenda and bridge the widening gap between rich and poor. ADB recently adopted a new long-term strategic framework to deal with these important issues. Our so-called Strategy 2020 focuses on 3 strategic agendas through which we can help developing Asian economies meet long-term challenges as they advance to higher income status. We want developing Asian economies to achieve inclusive growth, environmentally sustainable growth, and increased integration with the regional and global economy. In the longer term, we believe the region must make growth more inclusive, ensuring that all citizens are able to participate in and benefit from the process of growth. It has done a good job so far. Witness the remarkable progress the region has made in reducing poverty. Despite this progress, 600 million Asians still live in extreme poverty. So financial crisis or not, we must continue to create opportunities for them to escape poverty once and for all. In addition to becoming more inclusive, growth in Asia must be environmentally sustainable. Economic development in the last few decades has been very rapid, with great benefits to large segments of the population. But it has come with significant environmental costs, including the region's growing greenhouse gas emissions and the accompanying effect on climate change. Asia must find ways to develop cities, produce and consume energy, use land, and dispose of waste in a more environmentally friendly and sustainable way. Otherwise, the very growth needed to win the fight against poverty will be compromised. As countries move toward working more closely together, economies will naturally become more integrated. Asia's economies have grown larger and more complex, and they have also become more integrated through trade, direct investment, financial flows, and other forms of economic and social exchange. I'm quite sure regionalism is good for developing Asian countries individually, but it is also good for Asia as a whole, and increasingly it is good for the world. Ladies and gentlemen, we live in challenging times. The world financial architecture is changing before our eyes as the financial turmoil continues to spread. It will take some time to settle into a new, smooth operating environment. As Asian leaders deal with the fallout, I'm confident they will do so without losing sight of the need to continue bettering the lives of their large and diverse populations. And we at ADB, the region's key development partner, will do everything within our mandate to help them achieve this goal. Thank you very much. And of course, I'm very much looking forward to your questions and comments related to my presentation, but even unrelated to my presentation.
John McAuliffe from the Fund for Reconciliation and Development. First, I wanted to commend you for coming back so many times to the question of poverty alleviation as an important focus as the economic crisis develops. I wanted to ask, let's pretend that you're sitting in the room with the candidate who just became president, whose campaign was based on concepts of change and whose personal history actually involves having lived in the region as a child. What would you say to him? What should be done differently? What is the change, the most important change in American attitudes, policies towards Asia?
Very interesting but difficult question to answer. As you know, ADB is a non-political international institution, but let me say a few words as an individual. I mean, not as president of ADB. I'm quite sure that the U.S. Economy and society will experience a great change in coming years. That is, on one hand, necessary. On the other hand, it's going to happen anyway. From Asian perspective, U.S. As the biggest, strongest economy, as well as the superpower, continue to play a very important role, and I'm quite sure that the importance could even increase in coming years. First, as a matter of economy and finance, the sheer size of U.S. economy, its trade and investment relationship with Asian economies, and the dollar's unique status as almost the international currency, these would continue to be sort of key elements of U.S. Economic and financial relevance in Asia. As I said in my statement, although intra-regional trade in Asia is increasing quite rapidly, it has reached around 50%. But as I said, if you look at more carefully, the final demand from the G3 economies still play a dominant role, and the U.S. certainly is the most dominant role as the most important final market for Asia's export. So the economic financial matters continue to be really dominated by U.S. presence in Asia. But probably more importantly, kind of business model or role model or the ideal economic system, I think U.S. has provided to Asia, and this is in some sense even more important than the actual economic financial interactions between U.S. and Asia. The current financial crisis started in Asia, in U.S. Certainly has some negative implications on such a role by U.S. But still, so far, like or not, Asia has not, particularly emerging Asia, has not yet provided alternative business model or economic system model, role model, not only to Asia but also to the world. So I think Asia will continue to learn from U.S. As a role model or a business model of managing the economy and managing corporations and so on and so forth. Foreign policy is a bit more complicated and sensitive. And again, from my personal capacity, I hope U.S. will become more flexible, more cooperative, more friendly to Asia, because Asia is a huge, diverse region, as you know. There are advanced democratic societies. There are not yet so well-developed democratic societies. There are small countries, big countries, countries in political transition, countries in post-conflict situations, and so on and so forth. So Asia is so diverse, so complex, and the U.S. foreign policy will certainly be the most important foreign policy to be made or implemented by any country in the world, since U.S. is a superpower. As such, I think U.S. foreign policy would affect considerably Asian, international, regional relationships, and I'm hopeful that U.S. will continue or even strengthen such a role in the United States. Yeah.
First, may I commend the Asia Society for putting on events where we can listen to people of your stature and ask direct questions. I'm Robert Laidley, member of the Asia Society. My question, sir, is the same question I asked you in this room 3 years and 2 months ago. And it concerns the Turkmenistan, Afghanistan, Pakistan, India pipeline. And at that time, it was on hold. There have been reports that this year it's getting moving again. And I wondered if you would care to comment on the present status, and second, its importance with respect to perhaps bringing more stability to Afghanistan and Pakistan.
For some time, or I should say for some years, this pipeline project has been discussed among countries in the region, and also ADB has been involved in the discussion. At this stage, I must say that nothing is yet concrete. As you know, from the Indian perspective, there are a few options. One of them is certainly this pipeline from Turkmenistan through Afghanistan and Pakistan. And this project, if India does not join, would have reduced substantially the value, rate of return. So India's participation is really crucial for this pipeline project to be economically, financially viable and profitable. On the other hand, India has some other options. One option is pipeline from Iran. Another, maybe slightly smaller option, maybe gas pipeline from Myanmar and Bangladesh. So India, I think, is carefully assessing the various options, so related countries have not yet made final decision at this moment. But from a purely economic point of view, that would be financially, economically viable option, project. And as you suggested, it might have even some positive impact on the regional stability. But at this moment, I can't say anything definite. Yeah.
Yes, Masha Shvitsova here with Diligence, Business Intelligence Agency. My question is, how is the financial turmoil and the global recession is going to affect your donor contributions to the ADB? And subsequently, how is it going to affect some of the smaller programs or funds that were formed? For example, the Clean Energy Fund that was formed in 2007 and invests into Nepal, China, India, and helps with their clean energy projects. How do you think it's going to have an effect now with what's happening in the global environment? Thank you.
Of course, I have a great interest, as also I have some slight concern about the possibility of donors becoming less keen, less enthusiastic about their contribution to concessional funds. But so far, there has been no such move by donors. As you may know, the ADF 10 negotiations, the ADF is like IDA in the World Bank Group, the most important concessional fund for low-income countries. And the ADF 10 negotiations were successfully concluded just before the annual meeting in Madrid early May, with substantially increased ADF resources, something like I think in terms of the dollars, probably 60% more than ADF 9. In SDR terms, probably 50% more than the former ADF resources. So donors have agreed substantial contribution to ADF despite their fiscal constraints, so to speak. And various trust funds, including carbon fund, as you mentioned, have attracted great interest, particularly from European countries. And they have contributed already. Also, they continue to show great interest in contributing more. because those trust funds, most of them are related to clean energy and environmental issues, are quite crucial, important for developing member countries, of course. But at the same time, from donors' point of view, they would like to make real impact on environmental policies, environmental decisions in developing member countries. So although I have some potential concern about the implication of the financial crisis on the attitude of donors toward contribution, but I really hope that they continue to contribute to those funds to alleviate poverty, defend, protect the environment, and so on and so forth. Okay.
Steve Kargman, how do you think the global financial crisis spread from the developed countries so quickly to the developing world, such as the Asian countries? And how would you characterize the reaction of the governments and the economic policy makers in Asia to the fact that this crisis, unlike the 97-98 crisis, originated outside of their region?
I think the crisis started August last year, quickly spread to Europe. But the impact on Asian financial sector, financial market, were relatively limited up until quite recently. Of course, stock market, as I said, declined in line with G3 stock markets, and also economic slowdown has become more and more prominent in recent months. But really serious impact on the Asian financial sector or financial markets has emerged only after mid-September. That is the time when Lehman Brothers went bankrupt, creating credit crunch situations all over the world, including Asia. Two major impacts were felt. One is as I said, steeply rising risk premium for emerging economies in general. I mean, countries like Pakistan, which has currently serious balance of payment difficulty, may naturally face quite high and rising risk premium. But on the other hand, other countries like Indonesia, Philippines, Thailand, and so on and so forth, they have also experienced rapidly rising risk premium, 600 basis points or 700 basis points. Not very difficult to understand because, for instance, the Philippines has still very large current account surplus. Indonesia, Thailand, current accounts are almost balanced or with slight deficit, and no balance of payment crisis or anything like that exists in those countries. And yet, with increased risk avert or risk awareness among investors and financial institutions, they are now facing very high, almost prohibitively high risk premium. And that means that they have found extremely difficult to finance their priority development investment in the capital market. And this would have medium-term growth implications, serious implications, so that the World Bank and ADB, as well as bilateral agencies, are trying to step up their financial assistance to developing countries or emerging economies in Asia. Another impact is, of course, as you know, short-term dollar shortage has been very much accentuated in open economies with liberalized financial sectors like Korea, Hong Kong, Taipei, China, Singapore, so on and so forth. They have experienced a shortage of the dollar liquidity because American banks almost stopped providing dollar liquidity to those markets. And the Korean response was most comprehensive. Government, as I said, guaranteed up to $100 billion foreign currency deposit at Korean banks. At the same time, decided to provide $40 billion dollar liquidity to the market. And then recently, Federal Reserve Bank New York on the one hand, and Bank of Korea and Singaporean monetary authorities on the other hand, agreed to set up $30 billion currency swap arrangement each year. These would certainly help mitigate the dollar shortage, liquidity shortage among those very open, liberalized financial markets in Asia. But still some residual uncertainty, residual difficulty remain in those markets. And as I said, if the current global economic slowdown or recession is prolonged, eventually Asian economies would slow down much more than they have so far, creating even some problems in their financial sector. But at this moment, most serious impact since September has been two things. One, rising risk premium. On the other hand, the dollar shortage in very open financial market in Asia. So I hope with appropriate policies in G7 or G3 economies on the one hand, and pragmatic, careful response by emerging economies in Asia, the impact could be, if not minimized, but could be reduced.
One last question.
Harry Langer, the current fiscal crisis has been a direct result of the exotic derivatives that the global economy is invested in, and the credit default swaps devised to protect the so-called makers of these lousy investments, which should have been more highly regulated and perhaps outlawed. But you also mentioned the fact of liquidity. If you want global liquidity, wouldn't it be one way of doing it, cost-free and risk-free, would be to have a international mechanism like the IMF, the World Bank, and the OECD, put in controls over the investment of sovereign funds spent offshore to only financing industries in the global economies, restricting them from buying equities. and having the countries where these producers are borrowers guarantee the loans. This would solve an awful lot of problems and protect the investment of the sovereign funds, the capital investment. That's one way. The other thing is to address the real underlying problem of the fiscal crisis, which is the mortgage, subprime mortgage situation. Why don't they simply put a moratorium on all subprime residential mortgages for 3 to 5 years, rolling back the cost thereof, the debt service cost back to the original APR rates for the same period of time, phase in the bank requirements to mark to market and the higher reserves, which was 40 to 1 at the present time, over the same period of time, and then you have liquidity. Wouldn't that, and that would be cost free. Wouldn't that solve the problems?
I think, I know that in the United States there have been many proposals, arguments for solving mortgage loan problems. I understand. And I'm quite sure that the government would take appropriate measures to alleviate the situation. But on the other hand, from my experience in Japan, once real estate bubble burst, it's not easy to stop price decline until a new sort of equilibrium is found. And I understand many experts in this country argue that still housing prices would have to go down for another, 10%, 50%, or 20%, and so on and so forth. And of course, some measures must be or would be devised to alleviate the situation faced by mortgage borrowers, certainly as a sort of social policy. But still, housing prices may continue to decline, creating additional problems in the financial sector. And that, as I said, from my experience in Japan, is very difficult to deal with. And of course, once a kind of new equilibrium is found, becomes much easier to take care of. But during the process of adjustment, so to speak, of asset prices, like housing prices, with income flows and so on and so forth, I think that is extremely difficult. On the first point, I'm quite sure that many sovereign funds would become more active in their investment since already stocks in G3 economies have declined quite sharply, and maybe already some stocks have reached the bottom of or even overshooting the bottom. And that means that many investors, including sovereign wealth fund, would naturally be interested in investing in those stocks in U.S., Europe, and Japan. And some arrangement might be made, but I'm a bit skeptical about any sort of government intervention in the investment by fund or individual or institutional investors, including sovereign wealth fund, by way of guarantee or anything like that. That may not work as planned, and also in the globalized financial situation, it may be a bit more difficult than otherwise. But I may be a bit conservative, and I think there are many proposals and ideas, and certainly in the coming months, various proposals and ideas will be carefully considered, and some of them would be adopted in order to accelerate the consolidation of the financial sector and alleviation of the economic recession in many countries.
So I hope you'll join me in thanking Kuroda-san. And in wishing he and his colleagues all the best of luck in helping the biggest victims of this global financial crisis, who are the poor people around the world who you're trying to help. So thank you.